Artificial intelligence is transforming industries, and we're all chasing the next big thing. But not every AI stock can sustain its hype. SoundHound AI was last year's star, soaring over 600%. But is it still a strong play? Or are C3.ai and DigitalOcean ready to steal the spotlight? Let's break it down. And spoiler alert, you'll want to stick around for these insights. Hi! In today's video, we're going to explore SoundHound AI, C3.ai, and DigitalOcean, breaking down which stocks have the potential to dominate the AI-driven future and which might fall short. Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions or comments, feel free to share them. I'd love to hear from you. Let's dive into the video. SoundHound AI, last year's sensation. Let's start with SoundHound AI, a stock that was on fire in 2024, surging a jaw-dropping 602%. Its core business? Voice AI solutions. This is the tech powering everything from virtual assistants to voice-driven customer support. Why the buzz? SoundHound had a stellar year, backed by strong growth and even a small investment from NVIDIA, the king of AI chips. With all that momentum, its market cap ballooned to $4.7 billion. But here's the twist. SoundHound is down 35% in 2025, and it's raising eyebrows. Why? The company's valuation is lofty. It's trading at 11 times sales, pricier than even NVIDIA itself. Analysts are predicting the stock could tumble another 30% this year. So, while SoundHound has made waves, it might be time to look elsewhere for better value. Enter C3.ai and DigitalOcean. Stock number 1. C3.ai, positioned for AI dominance. Now let's talk about C3.ai, a company that provides enterprise AI solutions. Think of it as the toolbox businesses use to integrate AI into their operations, whether that's manufacturing, oil and gas, or retail. What's exciting about C3.ai? The numbers don't lie. In Q2 of fiscal 2025, C3.ai posted a 29% revenue growth, up from 21% in the previous quarter. Not only that, but they've raised their annual revenue forecast to $388 million, signaling stronger than expected growth. But here's the real kicker. The cloud AI services market, which is their playground, is expected to grow from $89 billion in 2025 to a staggering $363 billion by 2030. C3.ai is tapping into this massive opportunity by partnering with big names like Microsoft Azure, Google Cloud, and Amazon Web Services. In fact, Google Cloud alone accounted for 20 new deals last quarter, a year-over-year jump of 180%. And guess what? C3.ai is trading at a more reasonable 11x sales compared to SoundHound's valuation. Analysts predict the stock could climb to $40 in 2025, a 30% increase from today's levels, giving it a potential market cap of $5.2 billion. Verdict: if you're looking for a strong AI play with solid growth and better value, C3.ai deserves a spot on your watch list. Stock number 2, DigitalOcean, the cloud for developers. Next up, we have DigitalOcean, a cloud infrastructure provider tailored for small businesses and developers. While giants like AWS dominate the space, DigitalOcean has carved out a niche with its cost-effective and user-friendly solutions. Here's why it's exciting. DigitalOcean recently introduced AI-powered cloud infrastructure, leveraging NVIDIA GPUs to allow customers to train AI models, render videos, and more, all without investing in expensive hardware. The results? Their average revenue per user, ARPU, grew by 11% last quarter, reaching $102.51. This trend of increased spending per customer is driving their bottom line. For 2024, DigitalOcean projects $776 million in revenue, a 12% year-over-year growth, and analysts expect this growth to accelerate in 2025 and beyond. What's more, their target market is massive, worth $213 billion by 2027. With AI-powered offerings now in the mix, DigitalOcean is well-positioned to grab a bigger slice of that pie. At its current valuation of 4.4x sales, the stock is much cheaper than SoundHound or C3.ai. Analysts predict a 19% upside in 2025, pushing its market cap to $3.7 billion. Verdict: DigitalOcean might not have the hype of an AI startup, but its steady growth and strategic positioning in the cloud make it a smart long-term play. How do they compare? So, how do these three stocks stack up? 1. SoundHound AI has had its moment in the spotlight, but its sky-high valuation and recent pullback make it a risky bet. 2. C3.ai is riding the wave of enterprise AI adoption, offering strong growth potential with a realistic valuation. 3. DigitalOcean combines steady growth, new AI offerings, and an attractive price point, making it a solid choice for investors who value stability and upside. My take? If you're looking for high-growth opportunities in AI, C3.ai is the frontrunner. But if you prefer steady returns and lower risk, DigitalOcean is the way to go. As for SoundHound, it's a cautionary tale. Sometimes, the hottest stocks burn out the fastest. And while we're on the subject of will C3.ai and DigitalOcean surpass SoundHound AI? Stock breakdown and predictions. Let's take a look at other two key players flying under the radar. Want to discover two hidden gems in the stock market poised for a massive bull run in 2025? These companies are set to soar, and you'll want to know why before the rest of Wall Street catches on. Hi! In today's video, we're going to explore two exciting growth stocks that could dominate 2025 and beyond: Roku and DraftKings. Both are riding powerful market trends and making strategic moves that could skyrocket their valuations. Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions, feel free to reach out in the comments. Now let's dive into the video. 1. Roku, the streaming pioneer with a comeback story. Let's start with Roku, a household name that's quietly setting itself up for a big comeback. Roku has seen its stock price dip significantly from its highs over the past couple of years. But what's exciting is the underlying growth story that Wall Street seems to be missing. Here's the deal. Consumers are ditching traditional cable for digital streaming at a rapid pace. Roku is right at the center of this transformation. As of Q3 2024, Roku's streaming platform now reaches over 85 million households, a growth of 13% year over year. And here's what's even more impressive. These users are watching more than ever before. Total streaming hours hit 32 billion last quarter, up 20%. That's over 4 hours of daily engagement per household. Why does this matter? Advertisers are flocking to platforms like Roku to reach these highly engaged audiences. Platform revenue, which includes advertising and premium subscriptions, surged by 15% year over year, hitting $908 million in the last quarter. Now, here's where things get really interesting. Roku isn't just growing its audience, it's also improving its margins. The company's gross profit margin jumped from 48.1% to 54.2% in just a year. Management is laser-focused on further monetizing its platform with strategies like introducing new home screen features to drive ad revenue, expanding partnerships with content creators, increasing the number of subscriptions processed through Roku Pay. These moves position Roku to capitalize on the shift of ad dollars from traditional TV to streaming platforms. If management continues executing, Roku could be a major winner in 2025. 2. DraftKings, betting big on the sports wagering boom. Now, let's talk about DraftKings, the undisputed leader in the booming online sports betting industry. Sports betting isn't just a fad, it's a megatrend. According to Statista, the market is projected to reach $24 billion by 2029, and DraftKings is primed to capture a huge slice of that pie. DraftKings delivered a stellar performance in 2024, with Q3 revenue up 39% year over year, reaching nearly $1.1 billion. And here's the kicker. Management expects 2025 revenue to grow another 31%, which shows just how much momentum the company has. But revenue growth is only part of the story. DraftKings is making massive strides in profitability. Management is projecting $850 million in free cash flow for 2025. That's a huge turnaround from the early days when the company focused solely on user acquisition at the expense of margins. What's driving this growth? 1. Market expansion. Sports betting is already legal in 38 states, but two major markets, Texas and California, are still on the sidelines. Once those states legalize online sports betting, DraftKings could see a surge in user growth and revenue. 2. Customer engagement. DraftKings is not just acquiring new users, it's getting existing customers to spend more. With its user-friendly platform and gamified features, it's dominating in customer retention and wallet share. Here's the bottom line. DraftKings is trading at just over 3 times trailing revenue, compared to more than 5 times sales last year. That valuation, combined with improving margins and massive market potential, makes this stock an absolute bargain. Why these stocks are must-watch for 2025. Both Roku and DraftKings are positioned to thrive in 2025 for very different but equally compelling reasons. Roku is capitalizing on the unstoppable shift to streaming, while DraftKings is riding the wave of the sports betting megatrend. What they have in common is improving profitability and huge addressable markets. If you're looking for growth stocks with the potential for big returns, these two should definitely be on your radar. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights into the stock market and smart investing strategies. Got questions? Feel free to reach out in the comments. We'd love to hear your thoughts or answer your questions. See you in the next video.